Aboitiz, we can find a better way for a brighter tomorrow. We can find a better way. Text out serving beat each day. We can find a better way to better the example. With passion for the best. Better ways for a better day. Better ways for a better day. Better ways for a better 2017 Analysts Briefing. In line with our sustainability commitments and as previously advised, we are not providing printed copies of today's presentation. I hope you've all registered electronically. As soon as you encode your email, you will be sent a digital copy of today's presentation, which we hope you can view from your mobile devices. So if you haven't yet, please just approach Ivy over there at the table at the back so that you can get a copy of this presentation. And so now I'd like to introduce you to our presenters this afternoon. From left to right, we have Mr. Daniel Aboitiz, President and COO of AboitizPower's Oil Group. We have Mr. Justo Ortiz, Chairman and CEO of Union Bank. We have Patrick Reyes, COO of AboitizLand. And finally, we have Mr. Dini Lozana, CFO of Aboitiz Equity Ventures. Later on, we are going to be joined by Mr. Sabin Aboitiz, COO of Aboitiz Equity Ventures, CEO of Pilmico, and President of Aboitiz Infra Capital. With us in the audience, I'd also like to acknowledge the presence of Lisa Montalibano, CFO of AboitizPower. For this afternoon's briefing, we will present the first quarter 2017 performance of AEV strategic business units. We will begin with power, then banking and financial services, then food, infrastructure, and land. Afterwards, we will present the consolidated financial results of AEV and then hold a Q&A session. And now for our presentations, may I now call on Mr. Daniel Aboitiz to do the briefing on AboitizPower.
Good afternoon, ladies and gentlemen. AboitizPower recorded beneficial EBITDA of 10.8 billion, which is a 13% increase year-on-year for the first quarter of 2017. Increased interest expense and depreciation narrows the growth at the core net income level to 4% year-on-year from 4.8 to 5 billion. One-off losses related to Forex and derivatives bring the first quarter net income to 4.4 billion, which is 13% lower than last year. Our EBITDA grew 13% year-on-year, of which 9% is from the hydro business units, driven by improved hydrology, and 5% from the coal business unit, driven by fresh contributions from GN Power Mariveles, tempered by TSI Unit 1 outages. The 13% growth in EBITDA narrowed to 4% at the core net income level. This is due to increase in interest expense coming from the first period take-up of GMCP interest expense, as well as the bridge loan interest expense. Depreciation also increased due to the first-time take-up of the GMCP depreciation. AboitizPower recognized non-recurring unrealized losses of 577 million versus last year's gain of 242 million from Forex losses on revaluation of dollar-denominated liabilities and mark-to-market derivatives. These one-off losses bring AboitizPower's net income from the first quarter of 2017 to 4.4 billion, which is 13% lower year-on-year. At the end of the first quarter, consolidated cash and cash equivalents are lower by 1.3 billion as we continue to fund the construction of our various projects, and the group makes timely payments on financial obligations. Investment and advances increased as we take up our share in equity earnings of associates and joint ventures as we continue to invest in new projects. Consolidated assets increased from 355 to 358 billion as we continue to build up investments in greenfield projects. And total liabilities increased by 9 billion driven by the bookings of dividends payable to AP shareholders. Lastly, net debt to equity increased from 1.5 times to 1.6 times during this first quarter. Moving on to the generation business group's operating highlights. Capacity grew by 34% to 2,700 megawatts. This is mainly driven by the addition of GMCP. Ex-GMCP capacity or energy sales increased by 5%, capacity and energy sales increased by 5% to 2,100 megawatts, resulting from higher generation of the hydro units. The favorable performance of the hydro units compensated for the impact of Typhoon Nina on our Tiwi geothermal plant, the outages of Therma South, and the timing difference on the recontracting of a portion of our oil-fired capacity. Our solar units generation continues to be constrained by the congestion in the Negros-Panay interconnection transmission line. The group's capacity sold factor also increased to 90%. Again, without GMCP, this would have been 85%, higher by 1% than last year, mainly coming from our hydro plants. The contribution of GMCP and the increase in our hydro plants output kept our energy sales of 3,500 gigawatt hours on track with last year's, offsetting the lower sales from the rest of our plants. The decrease in the sales of Therma South largely results from the load adjustment notices issued by NGCP, while that of our oil plants results from lower dispatch from our customers. As these plants have capacity contracts, these reductions in energy dispatch don't impact EBITDA. The decrease in our geothermal sales, on the other hand, resulting from our Tiwi geothermal plant's generation constraint on account of Typhoon Nina due their energy contracts. Meanwhile, ancillary service volumes increased by 17%, benefiting from higher water inflows and higher acceptance of Therma Luzon's ancillary service offers. As you can see from this slide, water levels at the Magat Dam ended on the first quarter at an elevation of 187 meters above sea level. This is significantly above the rule curve of 180 meters above sea level. Looking forward, we expect normal hydrology for the remainder of 2017. Moving on to the distribution business group, beneficial power sales increased by 1% to 1,208 gigawatt hours, seeing minimal movement across all segments. This is flat versus 2016, which was considered a high-growth year, given the elections and the warmer temperatures in the same quarter last year. Peak demand likewise increased by 1% against the same period last year. The group's gross margins increased from 1.46 kilowatt hours per 1.46 pesos per kilowatt hour to 1.59 pesos per kilowatt hour year on year. The increase came from improved margins as operating costs decreased due to dispatch of Davao Light's Bajada Power Plant versus the same period last year. Further improving margins was the improved recovery of purchase power costs. Meanwhile, the system loss levels at all our distribution utilities remain well within the regulatory cap of 8.5%. Thank you very much.
Thank you. May now call on Mr. Justo Ortiz to do the briefing on Union Bank.
Good afternoon, everyone. Net income for the first quarter grew by 37% to 2.2 billion compared to 1.6 billion earned the previous year. The strong performance was due to the sustained recurring income coming from the strong expansion of both customer loan and securities at amortized cost. However, the bank also booked trading profits from its participation in a bond exchange program offered by the Republic in January 2017, plus double-digit growth in our fee income. If you break this down between net interest income and non-interest income, first we discuss net interest income, which grew by 11% to 3.9 billion. So this was, as mentioned, due to the robust growth in both customer loans and securities at amortized cost. However, there was a drop in our net interest margin by 41 basis points due to the lower average yields in loans, which can be explained principally because the growth in the loan book came or favored the lower yielding corporate loans as compared to our retail loans. However, at 3.4% NIM, this is still above the Philippine banking industry's average of 3.2%. So in the succeeding slide, I will show you the loan growth of the various credit portfolios and to explain this contraction in the NIM. Earning assets, so including securities, expanded by 24%, with loans driving the bulk of the growth at 29% and securities at 15%. So the mix of loans and securities to total earning assets was maintained at 78%. But within the loans, as discussed earlier, the retail corporate mix has changed. And this is what it looks like. So corporate loans grew by, total grew by 29%. So this is at a similar rate. Now in 2015, we grew by 22%, 2016 by 29%. So now 2017, we're continuing at that pace of 29%. But corporate lending, which is big ticket items, was the one that drove the growth. And corporate lending grew by 45%, commercial lending, which are to middle and small and middle enterprises, by 22%, and our retail by 14%. As a proportion, retail is now 38% of our total loan mix, which is still double or more than double than the industry average, which is 18%, which explains our higher than industry net interest margin. On the non-interest income, that's up 38% to 1.8 billion. Fee income grew by 18% due to higher loan releases, both in the Union Bank and CSB side. But trading profits in particular were up 11 times due to this participation in the bond exchange program in January 2017, which for us involved 169 million US dollars of investment securities. Miscellaneous income was down 16%, primarily due to lower trust fund income on account of the performance of the equity market and several one-offs earned in the first quarter of 2016. Deposits continued to grow at 26%, so it increased to 293 billion from 313 billion a year ago. CASA, in particular, grew by 17% to 136 billion as we continue to focus on our cash management business and increasing our customer base. So share of CASA to total deposits was at 35%, which still exceeds the goal of the bank, which is 1/3. So you can see that the NIM pressure is coming both from the yield side. It does not reflect yet on the cost of funds side, but as we see, unless we can keep the pace of CASA growth at the same pace as total deposit, then you begin to see pressure, and that's something that we're now consciously managing. Operating expenses are up 15% year to year, 2.9 billion, mainly on higher DST and GRT expenses, which is consistent with the higher revenue growth and loan releases. But in particular, taxes are up 83%, partly driven by this increased business, but a large amount of this is an accounting adjustment that we needed to make in 2017 in CSB that's not reflected in the 2016 numbers. Without that, our taxes would have increased by 29%, which matches the revenue growth. Capital adequacy is still higher than what is required at 15.1% for total CAR, and CET1 or Tier 1 equity at 12.4, higher than the 8.5% minimum. So we still have room to continue to expand and leverage the balance sheet. Return on equity is better than last year, 13.1% versus 10.8%. Our return on average assets is 1.7% instead of 1.5%. And our cost to income ratio is 51.3%, lower than 52.9%, but not equal to our goal, which is 50%. So that's something we need to work at. Finally, after a year or two of lagging behind, our stock has outperformed all the other listed banks. So we're number one year on year, 1Q to 1Q. So our stock price increased by 38% compared to peer listed bank and closed at 79.65 end of the quarter, outperforming both the PSEI and the financial index by 37% and 24% respectively. Thank you.
Thank you. So now I'd like to call on Mr. Sabin Aboitis to do the briefing on Pilmico and Aboitis InfraCap.
Good afternoon, everybody. Sorry I'm late. So for the food group highlights, first quarter, food group revenue was up by 8% to 5.9 billion against last year's on basically strong volume growth. But EBITDA slipped to 639 million or by 15% because of higher input costs and thinning margins. This resulted to a 300 basis point decline in EBITDA margin to 11%. For the first quarter of 2017, the food group ended up with a NIAT of 303 million or 24% lower than last year. The overall food group revenue up 8%, 5.9 billion against last year. All divisions contributed to higher revenues except for Feeds Philippines, which I'll explain, slipped 5% from last year's revenues. The flour up 4% in revenue or 1.6 billion, but basically a significant drop in selling price was offset by 6% higher volume. Feeds Philippines down 5% to 2.6 B. The volume was eaten up by a 5% decline in selling price. And Feeds Vietnam higher by 16% or 895 million, 5% growth in volume and 10% improvement in selling price. And the farms was the big increased by 38% to 650 million, driven by 27% surge in selling price and 7% increase in volume. The group EBITDA fell 15% or 639 million. Again, same thing. Flour and feeds, double-digit decline in EBITDA, wiped out by the positive EBITDA contribution of farms, feed Vietnam, and trading. Um, Breakdown is here, the same thing, more or less. The NIAT was down 24% to 303 million. The increase in NIAT contribution of farms, feed Vietnam, and trading was not enough to offset the slide in feeds Philippines and flour NIAT. The first quarter 2016, flour's NIAT slid 46%, challenged by GP performance and high operating expenses. Feeds Philippines 46% weaker, NIAT at 110 million, lower. That's because of lower IOIC, and Feeds Vietnam 27% better improvement in margin. Farms quadrupled against last year, brought around by the surge in selling price. So again, flour, the volume, 6% growth, but 65 to 65,000 tons, driven by export volume. Exports grew aggressively as we expanded our volume contribution to other ASEAN countries like Myanmar, Thailand, and Malaysia. The sales mix today, 90% domestic and 10% export. GP per bag, the GP is down 29% or 35 pesos per bag. On a 24 of it is an increase in wheat cost, and 11% a drop in selling price. That wheat cost should stabilize today. Stiff competition among flour mills also weighed down the selling price, and also the stronger dollar brought up our wheat cost by about 5%. Feeds Philippines, volume grew 2% on the increase of poultry and game fowl lines, despite an 11% decline in hog line. So what happens is we had a late last year we had a what they call the PED, which affects the piglets of the sows. Therefore, that disease brought down the number of piglets into the whole industry, not only Pilmico, which is offset. So now we have less swine to sell to. So we had to switch to lower margin sales, which is poultry, the poultry line. So you see the volume decent, but the margin down. And that's also why you see the sales, the margins, the selling price of swine up because of that decrease in piglets coming in, right? So that ramped up. So when you look at both of them together, they tell you basically the story, which is the feeds Philippines and the farms. Feeds Vietnam, we had a 5% growth in volume. We've expanded that mill last year, driven by volume growth in new markets, which are export and commercial. And this is basically in line with our strategic intent to grow volume outside of Vietnam. Overall volume grew 3%. So here the farms volume, the sales volume on number of heads, basically farms recorded an increase of 25% of volume because of our sow level expansion. However, the per kilo price, our volume stayed at 7% for two reasons: because of high market hog prices and low supply in the market. So now we are selling hogs at about 35 pesos per kilo higher than before. So you can see sales volume went up from 10 to 14, and you can see your average selling price, gross profits go up from 14 to 35. That's the one I was telling you about. Okay, so project updates. 2016 was a year that we completed a lot of our expansion plans, which you should now see volumes. The volumes go up this year. So our sow level ramp up to 14,200 is done. We have also done our first investments trial in our poultry layer egg farms. We put up 170,000 heads as trial. Next, in June, we'll be able to announce whether we're going to move this up to 1 million or not, depending on how the first cycle did. we are increasing the capacities of all our feed mills across all sites again. Um, and we also completed the most important thing, which is logistics, which is our inter-island pier to be able to move the volumes out. So having completed this set of expansions, we now move on the next wave, which is to bring our sow level up to 20,000 by 2020, 1 million birds for our layer farms, additional 40 tons per hour for our animal um, feeds production capacity in the Philippines, and an additional 20 tons per hour for our aqua feeds operation in Vietnam. So again, we start again this year expanding our mills. In 2017, we also broke ground on the following projects. For our farms, we will finish building our 2 grow-fin farms, expand our nursery farms, and we will, by start of 2018, so we start now 2017, our meat processing plant where we are bringing out new avenues to sell our meats for our farms, given that we are expanding the sow level again by another 30+%. And to further grow and strengthen our feeds business in the Philippines, we are again expanding our Tarlac feed mill and adding more grain and storage facilities. In the ASEAN, we've incorporated a new Indonesian trading company. I guess ASEAN is the hot thing last month or last by the government, which I agree with. I think the ASEAN way in the future is going to be big, right? You know, when you look at a positioning like Vietnam, where you have access to about 600 million people in the ASEAN, 100 million just on the southern China volume, which is the whole Philippines, the opportunities are really quite good. So we're really excited to expand that. So we've put up our trading offices in Indonesia and Vietnam, and expanding the operation there. Okay, thank you very much. AIC. Okay, so for Aboitis Infra Capital, um, so let's turn the infrastructure SBU, which is Aboitis Infracap, and our building materials business, which is Republic Cement. The first quarter in 2017 was really a challenge for our cement business. For over a year now, our revenues are down. For over this year, our revenues are down 12% on the back of an 8% decrease in volume and a 5% decrease in average selling price. Although volumes recovered from the fourth quarter of 2016, demand is below production levels in the first quarter of 2016, which is, I guess, a common occurrence for the post-election periods. Our average selling price declined basically due to greater competition from exports, which have now risen to about 7% of the total market demand, and a greater availability of supply from our competitors. So all of the above resulted in an income contribution to AEV amounting to 200 million pesos for the first quarter of 2017 from 391 million at the same period last year. Apo Agua, our 300 MLD Davao bulk water project. Apo Agua is basically our main, as you know, our main foray into the bulk water space. We are waiting. We continue with our pre-construction activities, and are waiting for permits to be able to start our project, which we expect to be in the third quarter of this year. We are again committed to doing this project, developing a sustainable water source for the fast-growing area of Davao City. Regional airports. We're not sure what's going on. It was delayed to June 2015 again. So for the unbundled regional airports, we wait. We wait to see what the final decision of the government will be. The deadline for submissions for the pre-qual was moved to the 15th, but we remain keen on these opportunities. Infrastructure in general. So we are optimistic with the government infrastructure program. This will affect us in a big way in cement and whatever the new PVPs or ODAs that the government is doing as far as for InfraCap is concerned, right? So they have committed, as we see, they have committed, the economic managers have committed the available fiscal space in the national budget for this, and the implementing agencies announced more details about the Build program during the recent concluded ASEAN meetings in Manila. Thank you.
Thank you, sir. Now may I call on Mr. Patrick Reyes to do the briefing on Aboitiz Land.
Good afternoon. In the first quarter of 2017, AboitizLand saw increases on all fronts compared to the first quarter last year, with NIAT at 72 million for the period, an increase of 46% from the previous year. Residential sales in the first quarter of 2017 amounted to 588 million, an increase of 12% compared to the same period last year. On top of consistent sales from existing projects like Almoa, Almia, Ahoya, and Prevea Hills, sales were augmented by the newly launched seafront residences, which I'll talk about a little bit more later. For the first quarter of 2017, AboitizLand contributed 640 million in revenues to AEV, up 28% from the same period of the previous year. This is mainly attributable to higher revenue recognition by the industrial business unit, which had a revenue contribution increase 42% compared to the previous year, and better sales and construction progress by the residential business unit, which likewise had a 20% revenue contribution increase. Commercial and other revenue followed a similar trend by increasing by 14%. Despite having increased operating expenses, AboitizLand delivered 284 million in gross profit and 86 million net operating profit, an increase of 33% and 35% respectively against previous year. The increases were mainly attributable to the company's increased revenues while maintaining healthy margins. I want to talk about Seafront Residences, which was launched in March 2017, and this was AboitizLand's first residential development in Luzon. It's a 43-hectare second home beachside development located in San Juan, Batangas, and is quite unique in that it is a house and lot project that is a second home. Most second home projects are usually lot only, and we decided to launch a house and lot project so that people can actually move into their houses in their second home within 2 or 3 years of buying the house. And this is also, we also partnered with people like DPZ out of Miami, which is well known for their second home developments, and Buji Royal locally for the architecture. And Seafront's also based on new urbanism design, so that it's focused on people rather than, for example, cars. So going on to first quarter 2017 business highlights, the launch event of Seafront Residences was a huge success, featuring a one-of-a-kind beach volleyball exhibition game in the middle of Bonifacio Global City for those who were able to attend. The event not only helped generate sales, but also propelled the company into the real estate industry spotlight through social media and various press releases. Keen to capitalize on this momentum, AboitizLand looks forward to a number of upcoming project launches in the months to follow. For current developments, site development and house construction progress remain on track for the residential business unit. The commercial business unit remains strong. In particular, the outlets at Pueblo Verde maintained full occupancy, while its expansion reached full occupancy after only 1 year of operation. Other projects also saw increases in occupancy levels, and the outlets at Lipa is now under full swing of construction. As previously mentioned, the industrial business unit continues to deliver sales while expanding its business portfolio, and is a key contributor to AboitizLand's success. This quarter, the industrial business unit sold 28 hectares, well exceeding expectations. Ongoing construction and expansion areas are approaching completion as well, with negotiations ongoing for future acquisitions. Lastly, in the first quarter, AboitizLand spent 538 million of its 5 billion capex budget for the year, with 95% of the spending going towards project development. The company expects capex spending to pick up throughout the year as more projects are launched. Thank you very much.
Thank you. Now, may I now call on Mr. Manuel Lozano to discuss the consolidated financial results of AEV.
Good afternoon. Nice to see you guys all here again today. We'll begin with a bit of a snapshot on our first quarter results. AEV recorded consolidated revenues of 33.8 billion pesos, which is a 22% increase year-on-year for the first quarter of 2017. Consolidated and beneficial EBITDA grew by 14 and 10% respectively. Interest expense increased and depreciation as well related to both of them related to the acquisition of GN Power Mariveles. So this is why the increase in EBITDA is not the same as the increase in net income. One-off losses related to forex on some of our liabilities and derivatives for the first quarter drove net income down to 4.7 billion, which is 7% lower than last year. So to be clear, core net income up 5% and net income down 7%. Our beneficial EBITDA grew 10%, as I mentioned, on a year-on-year basis, while our consolidated EBITDA grew by 14%. Out of the 14% growth in consolidated EBITDA, 13% came from power, which was driven by fresh contribution of GN Power Mariveles, higher contribution from our hydros, and the distribution group as well. Furthermore, higher EBITDA contribution from Union Bank also added to this growth. The 14% growth in EBITDA narrowed to 4% at the core net income level, and this is due to the increase in interest expense coming from additional loan and interest expense because of the consolidation now of GN Power into AboitizPower. Depreciation also increased due to the first-time take-up of GN's depreciation. AEV recognized non-recurring losses of 442 million in the first quarter versus last year's gain of 186 million. These are the forex losses on the revaluation of dollar-denominated liabilities and mark-to-market derivatives. But this is mainly the Thermal Luzon or the Pagbilao finance lease. These one-off losses bring AEV's net income for the first quarter of 2017 to 4.7 billion, which is 7% lower year-on-year. On a parent level, net debt decreased by 9% due to higher cash balances, but at the same time maintaining our net debt to equity at very low levels of basically 0.1 times. On a consolidated basis, as of the end of March 2017, consolidated cash and cash equivalents are higher by 3.1 billion due to the cash generated from operations that exceeded cash used for the funding and construction of our various projects and capex requirements. Consolidated assets increased from 364 billion to 475 as we continue to build investments in greenfield projects and also through our acquisitions. Total liabilities increased by 10.5 billion due to increase in bank loans and the booking of dividends payable to AEV shareholders, which were paid out in April. And lastly, net debt to equity is maintained at 1.1 times. So despite this additional debt that you see in our books that we've recently incurred for acquisitions and investments and the subsequent impact on our net debt to equity ratio, I just want to point out that our financial ratios remain very strong and that our organization remains ready to take on growth opportunities as they come. In this increasingly complex and unpredictable world, our view is that the most strategically, financially, and operationally ready company will be in the best position to take advantage of the challenges and opportunities as they emerge. To keep ourselves financially agile, we're always looking for new ways to finance our acquisitions and our investments. So as an example of this, AboitizPower announced last April that it had filed the registration for proposed fixed-rate retail bonds in the amount of 30 billion. This is registered under the shelf program of the SEC. So this is basically, we will initially issue roughly at least about 3 billion, but the goal is to have a quick ammunition when we need to raise money for further acquisitions at the AP level. The first tranche is about 3 billion and will be offered to the public sometime in the remainder of 2017. As the need arises, AP will issue subsequent tranches of these retail bonds. We continue to see growth opportunities in the Philippine economy, which remains one of the fastest growing in the world and in the region, definitely. From its 6.8 GDP growth in 2016, it is forecast to grow between 6.5 to 7.5% this year. Further into the future, Our NEDA has forecast GDP growth to be an average of 7 to 8% for the years 2018 to 22. We anticipate this to drive demand growth across most of our business units where we hold key leadership positions. But all of these, of course, are very competitive industries. So this would be power, financial services, food, cement, and residential and industrial real estate, as we enter a period referred to as the golden age of infrastructure in the country. But in the grand scheme of things, we see sustained Philippine economic growth as providing the group with a platform to advance business in communities wherever it operates and to drive change for a better world. We are committed to provide our equity and debt investors with a safe home for their investable funds, a reasonable and sustainable return, and a chance to be part of a growth story that they believe in. As I close, I want to emphasize how much we value the trust and confidence of the analyst community. Your partnership enables the group to continue telling its story to the larger investment community, which provides us with the capital we need to continue fueling our growth. Thank you again for being here, and thank you for your continued support.
Thank you. I'd now like to open the floor to your questions. So if you have a question, please just approach any of the microphones here at the center of the room, and then just please state your name and then the institution you represent, and then the person you're addressing your question to, and finally ask your question.
Good afternoon. I'm Christina Ulang with First Metro Investment Corp. My question is about AboitizPower, the energy generation, the sales volume. It seemed that GN Power is the one that creates the upside for this year because of the consolidation. But you would have some downside coming from the geothermal unit. And I noticed also the thermal plants, the sales volume dropped. Can you give us an assessment of whether the downside in the geothermal and in the thermal plant would be fully offset by your expectations in the dispatch of GN Power? I'm trying to make a gauge of how the volumes are gonna turn out.
Thank you for your question. As you can see, there are three negative numbers here. There are three downward pressures. Reduction in energy from TSI, which is the coal plant in Davao, although that plant is 100% contracted with capacity contracts and therefore has no effect. A reduction in energy dispatch of the power barges in Sipit and Mako, also capacity contracts and therefore no effect to bottom line. And then, as you rightly pointed out, the reduction in energy generation from APRI, which is our geothermal business unit. That's a temporary reduction resulting from shut-in wells and damaged plants at the Tiwi geothermal facility, which actually does exert negative pressure, but that is more than offset by GN Power.
Can you explain what's been behind the hydro being upbeat, ancillary wise and dispatch wise?
So improved hydrology, essentially
Water.
more water, has increased energy generation. Additionally, in our impounding hydroelectric plants, more water means higher elevation. Higher elevation results in higher available capacity, which results in higher acceptance of ancillary services.
What about the recontracting of the oil-based plants? What happens to the selling price trajectory there with the recontracting?
We're actually expecting either equal or improved selling price. We're working both the capacity contract and ancillary service dispatchable reserve fronts. There's just a gap now between expiring contracts and new contracts, which is why you see a reduction in contracted capacity.
But these contracts are going to be in place, all of them by what quarter?
I don't want to commit, but but we're working on getting that done as soon as possible.
So would the selling prices of all of the power plant categories, what's the general sense on the price trajectory? Because there's little visibility on the selling price movement in the first quarter. Like you mentioned oil, but for the coal plants, and would price be still relevant if you're contracted?
So at the moment we have, as you know, the nature of the power industry is cyclical, right? Capacity additions come in chunks. So we're now in a bit of a glut, and I think you can find that the margins in the new contracts will be lower than the previous ones. However, on the flip side, we are working on increasing the ancillary service contracts, which would provide positive pressure on that margin.
Sir, with the glut, is that possible, like boosting the ancillary sales?
I'm sorry, say again.
With the, as you mentioned, the glut in the power supply, is boosting your ancillary sales?
That is one of our strategies. Yeah.
Sir, there's glut, but would that be consistent with the glut? If there's already glut, how can you possibly boost ancillary sales?
The the ancillary service requirement, particularly for contingency reserve and dispatchable reserve, which is defined by the ancillary service procurement plan, ERC approved document. Those levels are higher than what is currently being contracted, so there still remains some space in that market.
Regular power. Reserve.
Yes and no. Both.
So it
Okay.
seemed the GN Power would really be the one that would carry the results in a big way for this year, for the generation business, as it is new and offsetting some of the downsides in the other parts.
Not only.
Not only. It's
It's a big
hydro.
chunk of what
It's a big
we
chunk.
added,
It's a contributor, but not.
but it's not only. But it's the huge chunk of what should comprise our bump for this year. But it's not only. There are other little things also in
So as we mentioned, improved hydrology.
Hydrology and ancillary.
We have some new capacities coming online.
So have some new capacities coming online later this year. Although GN is full year to be consolidated this year.
We expect the geothermals to recover.
Thank you.
Thank you, Christina. Do you have other questions from the audience? Yes, please.
Good afternoon. I'm Elizabeth from Abacus Securities. I have two questions for Union Bank. One first would be, could you elaborate on the accounting adjustment for CSD, and also could you give some color onto the growth in your corporate loans? What industries, what industries were these loans given to, and are they short term or long term in nature? Thank you.
Okay, the accounting adjustment has to do with GRT, which in the past there was some netting done, which the revenue regulations no longer allow. So that created a larger GRT bill on a similar revenue base or a slightly higher revenue base. The second question was about the industry. So the not real estate. So let's start with that. So we don't have much loans on developer finance. It's mostly retail mortgage finance on the real estate side. So that's long term. And then a lot of the other loans are to conglomerates for their specific projects. It may not be to the conglomerate itself, but to units, operating units of the conglomerate that are um, doing different expansions and some even pre-funding of future needs. And then the telcos.
Thank you. Does that answer your question? Yes. Okay. Do you have other questions from the floor? Yes.
Is Con from First Metro Investment. I'd like to ask your outlook for your cement business. If you can give us your target volume for the year, and I would like to ask what's the industry supply demand situation right now.
The outlook for cement is really dependent on the infra program. No? Two things affected it last year, right? One was the imports, right, and one was basically the elections. So the imports, like I said earlier, was 7% of about our estimate. Very hard to estimate the exact, but about 7%. We expect the imports to go down this year because of hopefully the full implementation of what I said the last time, which is the Department Administrative Order, or the DAO, which makes it more difficult, or you kind of implement the law of import, right, to make sure that the cement is strong, etc., etc. So that we expect to be implemented. So that should affect a little bit, and then the infra spending, which probably will kick in if any time later this year, not so early, right? When that kicks in, we expect the demand to really go up. So I would say that it's hard to predict. I would say it would be down. We don't expect it to have a strong increase this year. Although we expect it to have a very strong increase next year when the whole spending is in. We expect prices to have probably bottomed out because the selling price has come down because of a lower demand, a lower supply, lower demand, sorry, and competition. The supply side is still fine. It's strong. We, for example, are not operating, full bore. So there's not that big of an issue with the supply side as of now.
Thank you. Does that answer your question? Do we have other questions from the audience? I have a question here for Mr. Sabine Aboitis. Are there any plans for Pinico to take on an IPO?
No, as long as Mr. Dimi here just lends us the money, I think it's okay. No, I think Nico has enough cash flow to be able to handle all its expansions.
Do you have other questions from the audience? Yes, Christina.
My question for Mr. Ortiz. Sir, what's happening in city savings? Why the slower loan growth relative to your 29% overall?
Well, it's a maturity question. We already, out of the 700,000 teachers, we deal with 40% of them. There's more competition. So incrementally, when we started 3 years ago, we had 100,000 customers. Now we have 3 times that number. But to go at that same rate would be impossible because to double would be 100% of the market, which is probably not realistic given the competition.
Sir, so does that mean city savings is not going to be the bulk earnings contributor that it used to be, like with more than 3 billion in earnings?
No, it still will because it's still growing, and loans are ADB, right? So the ADB this year is still high from the prior year's growth. But it will start, growth will definitely start slowing down next year. I mean, you'd see some of it to this year. Now, relative to the rest of the bank, it's still a large chunk, about a third of our income.
Sir, I noticed that the earning assets yield are dropping, and although the advantage is that your funding cost is still stable, what would be the strategy going forward if you are to like maintain your NIM?
Well, the strategy really is to grow the retail side of the bank because that's higher margin. But it's lower ticket sizes, so it's difficult to grow. So for as long as we're continuing to see uh, net income opportunities from an ROE point of view by continuing to leverage the bank, in other words, we have a net marginal contribution, then we will continue to push loan growth. And that loan growth is anchored currently on corporate loans. But even that will need to plateau because it's capital intensive. So we've been growing, like you saw, our corporate loans grew by 45%. Our capital did not grow by 45%. So while we still have room in our CET1 and our CAR ratios, we can continue to push that. Our LDR is also relatively low. It's, I think, 63%. So we have both from a liquidity standpoint and from a capital standpoint, we have an opportunity to continue to grow that. But that's also going to start leveling off once we've optimized our balance sheet.
Mm-hmm.
And then meanwhile, we're hoping that over time, like I pointed out, our NIMs are still higher than the industry. Their NIMs are also under pressure in the first quarter. But over time, we expect a steepening of the yield curve, and hopefully that would produce incremental on an industry-wide basis.
So more room for growth, balance sheet wise.
Yeah, that would still be
So no need for any.
the main levers for growth in the next 24 months will still be leveraging the balance sheet. I mean, you're aware that we're among the lowest leverage. And that was because we had a different strategy, which is preserving the leverage for proprietary trading activities. So we've stopped doing that in our peak year was 2013, and we've since been adjusting.
So no immediate need for any rights offering or
No immediate, yeah.
LT and CD.
There's no margin there on the LTC and CD.
Yeah, at 3.5. Yeah, thank you, sir.
Yeah.
Thank you, Christina. Do you have other questions from the audience? Yes.
Sir, do you have any expansion plan for Republic?
Yes, we do. We have a plan to expand more another kiln or an expansion kiln and debottlenecking now. So that would probably be maybe in the next year or two, getting permits, etc., etc. But kiln capacity and some grinding capacity.
Thank you. I have a question here for Patrick Reyes of AboitizPower from one of our analysts. It is asking, what is the remaining land bank of Aboitiz land after deducting projects for that have been launched?
Yeah, we have about 500 hectares of remaining land bank available for development, but we're constantly looking for new land to acquire to develop.
Thank you. So I think we have time for one more question. Do you have anyone from the audience who'd like to ask any more questions? Please take advantage of the presence of our executives. We have traveled all the way to Makati from Fort Bonifacio just to be with you. So, and Danelle from Malabon. So, and Ortigas. So, please maximize their presence. Don't be shy. Any last questions from the audience today, or not unless you're planning to just? Oh yes, yes, please.
Jillian Gaza from JP Morgan. Can you give us an update on retail electricity industry and your current position and your current marketing plans or any targets? Thank you.
So as you know, open access has been moving forward, albeit with some delays moving forward, and the minimum peak demand required to participate in open access is on a downward trajectory, increasing the number of customers available. We have a number of RESs. We've been aggressive on that front. We're actually most aggressive on that front. So we're on target. Contracting the capacity we intend to contract via open access. Sorry if I answered your question properly.
Last question. Okay, so if there are no more questions from the audience, let me now close our Q&A. Please remember to complete and leave behind our feedback forms. No? So we're going to be going around to collect them. And we'd like to thank everyone. Thank you to our guests and to our presenters for today. This wraps up our first quarter briefing. See you again on August 2 for our second quarter results briefing. Meanwhile, please enjoy our refreshments outside. Thank you, everyone.
Better ways for better days.